G'day, my name is Brian Johnson, and today I'm talking about continuing on with trading with limit orders and position averaging in a downtrending market with serious economic considerations. So, having said that, remember, 95% of people lose money trading the Forex. The Forex, you should never put at risk any money that you're not prepared to lose. Having said that, one in this extreme economic circumstance can still trade, and I would suggest demo, or if you're trading live, scalping in very close proximity to the market, in other words in the lower time frames, 15 minutes. Here I'm showing you a 1 minute time frame, and I'm just showing you some general considerations that you should do in limit orders. As you can see, this is we took a bit of a hammering in the great downturn on the market, and we went from an opening count of 5,000, and we had to take off some trades and adjust to the new market condition. So we lost a bit of our profit, but we're still above our original drawdown, which I think is an important thing to remember in trading in the Forex and using drawdown to your advantage. So without further ado, you can see I've readjusted my positions and taken out the I've left some JPYs, Euro, and some US dollars, and taken off basically the JPY, US dollar, JPY group. The reason is that this is totally unstable in this market, and it's causing great fluctuations. Okay, having said that, we put on a position averaging at 1.04775, and if you remember in my last video I said you should follow Boson's lines always and look at the daily trading range. So the trading range is expanded quite considerably in a short time, so we'll look at it. The trading range went from 120 or whatever up to 322. Now that has caused you to think that if we come back to the position average of the Australian dollar, we would not want to put on the next position unless we dropped at least another 325 pips. We've got one on, and we don't want to put another one on until we reach the 325 pip level down from that. And why I say that is that would be your second position average in a falling market. I repeat, that would be your second position average in a falling market. As you saw in my first range, you could not enter unless you had the conditions of the Fibonacci, and we did that in the 4-hour time frame, and you would need to enter that at the 23.6 condition if you used those points, and we would have to adjust them to the new trading range, which I haven't done, which is simply putting it on your fib, and we'll delete these fibs once again, and we'll simply do it as a trading range video template, and we'll come back and we'll put re-put on the fibs, and you would have to look at putting on the fibs between the 2 points and entering on the next position down only if you got to 23 point that in your price. It's still not there, and we have one position on and we wouldn't put another position on unless we got down at 300 pips and the range had changed. So the other two prime requirements, I would say that one should never ever trade the Forex unless one is prepared to lose money and prepared to take a loss. One has to take a loss occasionally, and in this case we took a loss. We went down from 5,300 down to 5,000 equity, 5,245. The opening balance was 5,000, so we're still above our opening balance, and we've retained our drawdown to a satisfactory level. Of course, this takes experience in trading, and trading in real time in this sort of market where the US dollar, economic circumstances, Switzerland's propping up, trying to reduce their price for the CHF, and Japan, and while you have government interventions in the currency market, one has to either trade scalping in short periods of time or using position averaging with your next position wide of any range. So think of it this way: once you get to two positions, do not enter a third position unless you're way past the trading range, and in that case was 300 odd pips. I would go 400 pips away from that and just wait until the market stabilizes. Remember, greed and lack of patience costs many a trader lots of money. Do not put on more than you can afford to lose. Remember, trading the Forex is a risky market, especially when these economic circumstances dictate otherwise. Personally, I would stick with demo trading to improve your skills until the market stabilizes. God bless, from Brian.